Welcome to Investing with JYK, and it's been a long time since I last published anything. Um, sorry about that, but today we'll talk about Sinopec Shanghai Petrochemical Company. The ticker in the US is SHI, and for those that speak Chinese or no pinyin for that matter, um, it is somewhat similar to how we pronounce shit in Chinese. In any case, so this company is a subsidiary of Sinopec, and it's the largest. Well, here's a 20F. Anyway, so you can take a look in here. No, let's. Here's a bunch of risk factors, and it actually goes pretty far down. Yeah, business overview. So they're one of the largest petrochemical companies in China, and they're based in Shanghai, which means their sales are basically to Eastern China. And let's go to Shanghai. All right, so Eastern China, including parts of Jiangsu and Shanghai and Zhejiang and also Anhui these are one of the more economically vibrant regions of China. And it's not at all surprising because this is a Yangtze River Delta. And China basically has like this Zhujiang Pearl River Delta here. And then the Yangtze River Delta. And in here is basically Beijing. So this is like the second economic engine of China. They kind of Guangdong and Eastern China kind of compete for that title. And this company sells, as listed here, they sell some synthetic fiber, some plastics, and then they sell fuel essentially. In terms of the stuff they sell, all right, here are the stuff that they sell, and mostly in terms of mass, it's mostly just diesel and gasoline, and then jet fuel, and then you have a bunch of plastic stuff and fibers. They also are engaged in some trading, so import-export of petrochemical products, but the profit contribution from that business is quite low, so I typically don't pay any attention to that. Okay, so let's look at valuation. So one thing you can notice that this thing, let me see if I can change this to English. The English translation on this website is not perfect, but it's better than nothing. Okay, so dividend yield is about 6%, and then PB is 1.5. That doesn't sound awfully cheap. Sounds okay. That's because this is not the one you want to buy. You really want to buy the same shares on the Hong Kong exchange or the ADR, which is based off the Hong Kong exchange. And when you look at this, you can see that the PB is 0.79, 0.8 basically. Dividend is about 12% plus. Now, granted that unlike American companies in many other regions of the world don't pay a steady dividend. They will just adjust their dividend based on the profit of that year. So there will be periods, and you can see here, there will be years where they pay zero dividend. This is a dividend yield rate, dividend yield, and And you can see this is basically the highest ever this company has ever been in terms of dividend ratios, dividend yield. Okay, and here is PE, historical PE for basically 20 years. They went public in 2001. And this is a cyclical company, and I'll explain why this is cyclical slightly later. But it's a very cyclical company, and therefore there will be periods where they lose money. Hence these negative PEs basically. So a better metric for valuation would be PB or PS. And in terms of PB, back here they were not really mature, but once they're kind of mature, which is 2012 is when they finished the last round of expansion. You can see this. We are essentially the lowest ever, the lowest PB ratio since 2012, basically. And then for anything that is even lower, you have to go to the depth of the crisis. In that case, the PB ratio was half of what is now. So imagine if we had, well, here is actually a double whammy, but I'll get into that later, why that's a double whammy. And then in terms of price to sales, again, you're looking at here 0.13, now it's 0.22, and then in 2014 their periods was 0.1, so there's again a 50% downside. Dividend ratio, and on the other hand, you are at the peak. So overall, I would say the company is very cheap compared to its past self. And what else has changed for the company? Obviously, the profit has grown over the years. So you got, well, hold on. If you look at growth analytics, yeah. Just look at the blue bar, and essentially you can see the operating income has generally been increasing. Obviously, although it has not been as high as 2013, I would say. And net profit, you can see there are ups and downs, cyclical company, as I said, but in general, the ups are slightly bigger than the downs. And cash flows is actually looking better than profits. And you can see they are consistently building equity instead of destroying equity. Obviously, there are periods where they do destroy equity, especially in 2008. But that is somewhat expected. That is, after all, the depth of the crisis. Okay, and what else? The other thing that has changed for this company over the years is its debt. If we look at, I think there's a thing called cost analysis. Ignore these for now, get into an analysis of its gross profit. But the thing I was going to show here is you can see the financial expense. Well, I think it's called interest expense. Most of the time, it's just got interest expense on if you're looking at GAAP statements. But in any case, it's gone down as a percentage of revenue, and now it's negative, which means the company is, well, I can't really say it's net cash, but it has more cash than interest-bearing debt. And that's how you can end up with a negative interest expense, because you have interest income. Yeah, and the other thing is, if you look at net margin, you're looking between, well, the 20-year average is 2.27%, which is expected of a commodity business. you're never going to make, over many cycles. Here we're looking at from 2002. Over many cycles, you are not going to see a very high margin. That's just not how commodity businesses work. And the peaks of these up cycles correspond to about 10% profit margin. And at the moment, we're slightly below the long-term average. And if you look at gross profit, we're slightly above the long-term average. So does that bode well for the future gross profits? Probably going to decline. It could, but it has been pretty high for a couple of years, and then even in 2018 when gas prices was oil price was increasing, 17 and 18 really. Oil price was increasing there. They kept their gross margin fairly well, and then there are some things that I was observed that also contribute to if they call it triple expense ratio, but this is really just SG&A. SG&A has gone down as a percentage of revenue, which is what you want to see. So the company is getting more efficient as time goes on. And the other thing that people always get a bit hang up on is state-owned enterprises. This is a state-owned enterprise, but there are many signs pointing to that the management is trying to improve the company overall in many aspects. So that's the cost analysis. Mostly I was just going to focus on the reduction of debt. And what else? Very high dividend. Maybe let's say next year they get cut in half. You're still getting 6%. And there's one more thing I want to show. There was a very interesting phenomenon which makes zero sense to me. Okay. I need to look at the Chinese one. Yeah. So this is the A share one, right? And there was a mechanism which I've talked about before, which is called the Hong Kong Stock Exchange Interconnect or something. Essentially, that enables people to buy A shares in Hong Kong and buy H shares, basically some of the H shares, some of the Hong Kong listed shares in China. And it started in 2017. And this is the A share, and then as we talked before, the A share is about 100% more expensive than the H shares. The dividend is about half, and then your PB is about double, and right, so it's basically doubly as expensive. And for any normal human, for the exact same share, you would not want to pay twice. I mean, technically, it's not exactly the same, because in China, if you hold an A share for more than a year, and you're a Chinese citizen, you don't pay dividend tax. And in Hong Kong, doesn't matter what happens, you gotta pay 20%. So it's arguable that H shares should have a 20% discount compared to the A share, because you gotta pay that out as a dividend. If you hold the thing forever and you only live off the dividend, then your coupon your dividend is essentially 20% less. But this is not 20%. This is a 50% discount. So this doesn't make any sense. And then why would anyone this orangish shade, that area it represents the percentage of float that was bought by people using the Hong Kong exchange. So that makes zero sense to me. It's probably some index fund, because why would anyone pay double to get the same thing? That's what this is happening. Is paying double to get the same thing. On the other side, if you look at this makes sense. Whenever the floodgate opens, you would think that the Chinese would sell all the A shares and buy the H shares because it's higher dividend. But this thing is only representing, just a bit more than 1% of the free float. Well, not the free float, the market cap, which is actually slightly higher in terms of percentage if you're talking about free float, but still, it's a very small percentage. It still doesn't make much sense. Anyways, that was just something I was going to rant, because it's quite stupid that people are paying more for the same thing, as shown here. Okay, so what else was there? So the cyclicality, how to understand the cycles regarding this particular company. So I got all the data out of all the related data out. So we're gonna take a look at my Excel. Okay, so what I have are the gross margins, and the other thing is the oil price. Right? So I got all the oil price and then gross margin, and then I charted it, and this is what you see. The blue line is oil price, and the gray line is gross margin. And you can see that generally, whenever oil price is going up, gross margin goes down. And when oil shoots up, gross margin shoots down. And here is an anomaly. We'll discuss that later. When both oil price and gross margin were going up for a period of time. Well, for basically a year. I messed up this horizontal axis, so never mind that. But this is quarters. These are basically quarters. And then here's another thing: when you have a move in the oil price going down, and the margin goes up. And now in 2000, this is basically 2007-ish, I think. Sorry, 2017, 18 or 19. This is the last quarter's 19, so 18-ish. When you got oil price going up, your margin goes down. And why is that? Normally, this is more similar to a refinery in the US, right? Because you take in crude oil, and then you produce some fuel. And we all know that whenever oil price goes up, you notice the price at the pump will change, and then that will go up. And which means that these refineries don't really care too much about the price of oil. If price of oil goes up, they increase the price of their output. And yeah, so they don't really care. Of course, you're gonna get a little bit less sales because people tend to drive slightly less when oil price is higher, but their gross margin is more or less protected. But in China, there's the government actually sets the price at which fuel is sold, especially gasoline. I'm not sure about diesel, but yes, diesel as well. Maybe jet fuel is free floating, but diesel and gasoline definitely are price controlled. The price control is not ridiculous, as in like the state would subsidize or make a ton of money off people, and they do float whenever oil price kind of gets out of whack. But there is a lag. So instead of the companies changing their price daily or weekly, you get these changes. Some bureaucrat has got to do that, and then the bureaucrat will do it maybe once every 3 months, right? And that's what results in these inverse correlations in terms of gross margin. And yeah, so when and the thing is, at this point, when the gross margin is deeply negative in 2000, this is 2009. When gross margin is deeply negative, well, let's first talk about the double whammy. So this is 2008, late 2008. This is when the stock price was the lowest. If you look at here. Let's look at just the stock price. Market cap was from the start. This is when it was the lowest. If you look at, oh, come on. Here is all very messed up. Usually it follows. I think it's because I changed it into English, so now it's kind of messed up. But let's see. This is the Chinese one. I need the Hong Kong one. Okay. The Hong Kong one, and I need from the start. Yeah. That's this line, this thing here. Well, actually this, I think 24-ish is when the price was the lowest. It was third quarter of 2008. And the reason was in late 2000, well, in the middle of 2008, the oil price shot up quite a bit from something like $50 a barrel to more than 120. And obviously the government doesn't change price as fast. So that ended up making, well, a huge loss on this company. And but obviously the government's got to catch up, so they started adjusting these prices, and at the same time the oil price went all the way down. So that kind of resulted the gross margin recovery, and then still you got more price increases in oil. Well, oil went all the way down, and then your government price adjusted upwards. So you can see this kind of overshoots to higher than what was before the oil price jump. Before the oil price jump, you could argue it was, somewhere between it was 7% gross margin. And after the spike and the drop, the gross margin now went to 17%. So that is because the government actually increased the price to higher than what it was sold in 2000, and this was 2000 and I think 5. It would be nice if I had data about the historical price at which fuel is sold in China, but I couldn't seem to find that. So maybe I'll dig that up, and if I do dig that up, I'll put it in the description. Yeah, and then that's why, I mean, that's for the fuel part, which is about 40% of the business, and then the rest, which is plastic and fibers. These demands are very cyclical in term they basically is a little bit leading the overall economic cycle, because these are basically needed for production, and they are generally not what the consumer want at the end. So they are basically inventory for somebody as raw materials, and then the demand for these basically crater whenever your economy goes down. And yeah, when the demand craters and you got the fixed capacity for the production of these essentially raw material, almost like raw materials, then you really can't expect very high margins. You probably can't even expect positive gross margins, because sometimes people will produce even though they make a gross loss because they have to cover for the depreciation, and then they have to have some they have to have some cash flow to sustain their business. They basically burn down. I mean, if you think about it in terms of accounting terms, they kind of tap into that depreciation and amortization part of the future. They can defer maintenance expenditure to the futures to make sure that the company survives. And they were in somewhat precarious positions back then in 2008. You can see there was let me see if I can find it. There's a thing called safety analysis, very interesting. Long-term solvency, you can see the liabilities was in terms of total asset ratio was fairly high in late 2008, and they also had another bump in 2012. Liquidity wasn't that good here, and as you saw before, their shareholder equity was fairly low. Gross analytics, yeah. The huge drop of shareholder equity was caused by that spike in price, and then the slowdown of economic activities during the financial crisis. Okay, so I have bought some shares of this company. Obviously, I bought SHI. Basically, I got it in at 30. It's now slightly lower, but I'm not too worried because I am getting a decent dividend. Oil price at the moment, I would say, is on the slightly on the upside compared on the downside. I think I think oil has more probability to go lower than higher, and the company itself is very unlikely to die because of no debt, so they have plenty of opportunity to increase their leverage. Oh yeah, and there's this thing where I forgot. Other than this, I took a look at their production, and I look at one thing that was most egregious in terms of low efficiency in Chinese state-owned enterprises is the bloated headcount. So I took a look at their headcount, and you can see the headcount actually went all the way down from 31,000 in 2002 down to just 9,000 in 2018. And at the same time, their revenue increased quite a bit. You can see the revenue was on the, this is in like 22 billion, and now they're at 107 billion. And I also took out their employee cost. This is in terms of billions, and then that was 2.87% of their revenue. It also went down from almost 5%, now down to like 2.5%. It's not as impressive as the employee headcount decrease, but the average salary in China is increasing. So yeah, so there's that. But you can see they are increasing efficiency, right? So it's they're not just sitting still and letting people, almost like eat for free and leech off the enterprise. The one thing that you might want to look at, and then this is, I think, a common problem for many Chinese companies, is the retired employee count. There's some missing data. I couldn't find that. But retired employee count keeps going up because people, I mean, they still did the right thing. They retired them, so they pay them less. But these guys are going to live another 30 years after they retire, because especially women in China retire at 55. And then they live until, if you retire at 55, it's very likely you live until 85 or 90. And, that doesn't make sense, because you kind of have no use until you're 20, and then you work for what, in this case 35 years, and then you got another 30 years of no use, right? So you end up with 50 years of no use, and then essentially being non-productive, and then 35 years of productive years. It just doesn't make sense. I think China has to increase its retirement age to probably something like 70 instead of just 55, which is ridiculous. Like, it's just ridiculous. Yeah, so this is a thing that many Chinese companies would face. Going back to the conclusion that I was drawing, that I got sidetracked. Yeah, so the company is cheap relative to itself, its historical self, and then you can see the percentage. This is what we want. Excuse me. Very cold in Shanghai. We need to look at the Hong Kong one, right? So, and then you look at value analytics. I think they just want to say analysis. It's at about 20th percentile in terms of valuation. It's not the cheapest ever. PE is kind of useless. And then in terms of PS is 26th percentile, and dividend yield, it's at the highest ever. And I think this company not only is a good choice on its own, it's even better if as a hedge to any long oil positions in a portfolio. So if you had something like an E&P company, or anyone with a upstream business, then this guy is a positively carrying hedge. It's an income producing hedge, which is kind of nice, right? Yeah, so that's that. And I hope you enjoyed this analysis. And if you have disagreements, thoughts, please let me know on the comments. Even though I don't post, I still read the comments. And I may have another 2 ideas coming. So see you next time.